BlackRock CEO Larry Fink just dropped a bombshell. He believes most investors are making a huge mistake in their market outlook. In this video, we'll dive into Fink's warning and why it matters to your portfolio. We'll explore the disconnect between current market expectations and economic realities, backed by real-time data and expert analysis. I've spent days researching this topic, combing through economic reports and market forecasts to bring you the most accurate and up-to-date information. By the end of this video, you'll understand the potential risks ahead and how to position yourself for what's coming. Let's get started. Larry Fink isn't just another Wall Street talking head. He's the CEO of BlackRock, the world's largest asset management firm. To put it in perspective, BlackRock manages a staggering $10 trillion in assets. That's more than twice the entire GDP of Germany. When Fink speaks, markets listen. He's not just observing the financial world, he's actively shaping it. BlackRock's investments touch nearly every corner of the global economy, giving Fink unprecedented insight into market trends and economic health. His warnings have predicted major market shifts in the past, and ignoring them has cost investors billions. That's why when Larry Fink says the market is wrong about something, we need to pay close attention. Here's where things get interesting. The market is currently pricing in multiple interest rate cuts for the coming year. Investors are betting that the Federal Reserve will start slashing rates as soon as their next meeting. But here's the kicker. These expectations don't align with what's actually happening in the economy. The U.S. isn't showing signs of a recession or even a significant slowdown. In fact, it's quite the opposite. We're seeing robust economic growth, a strong job market, and resilient consumer spending. It's like the market is preparing for a rainstorm while the sun is shining brightly. This disconnect is what's got Larry Fink and other economic experts concerned. They're warning that if the Fed follows through with these expected rate cuts in a strong economy, we could be setting ourselves up for some serious economic turbulence down the road. Understanding this mismatch is crucial for making informed investment decisions in the coming months. Let's dive into the numbers that are painting a picture of a surprisingly robust U.S. economy. First up, GDP growth. The Atlanta Fed's GDP Now model, which provides real-time economic forecasts, is currently projecting a growth rate of 2.5% for the third quarter. That's not just good. It's at the high end of analyst expectations. This isn't a blip either. We've been seeing consistent strength in economic output. Now, let's talk jobs. The latest employment report blew past expectations, with nearly double the number of new jobs created than economists predicted. We're seeing historically low unemployment rates and steady wage growth. This isn't what a struggling economy looks like. Consumer spending, which drives about 2/3 of U.S. economic activity, remains strong. Retail sales are holding up, and services spending is robust. People are still eating out, traveling, and spending on entertainment. These indicators paint a picture of an economy that's not just stable, but thriving. It's this strength that has Larry Fink and others questioning whether the market's expectations for rate cuts make sense. If the economy is doing this well, why would the Fed need to cut rates aggressively? This disconnect is at the heart of the current debate and could have significant implications for investors. Remember all that talk about a soft landing or hard landing for the economy? Well, Larry Fink is introducing a new term, the no-landing scenario. This means the economy just keeps cruising at its current altitude, with no significant slowdown in sight. It's like a plane that just keeps flying without needing to land. In this scenario, we're looking at continued economic growth of 2 to 3% annually. That's not just good, it's remarkably stable and strong, especially compared to other developed economies. Now, let's talk about bond yields, because they're telling us something important. The yield on 10-year Treasury bonds has been climbing, recently surpassing 4%. This isn't just a random number, it's a big deal. Rising bond yields typically signal that investors expect stronger economic growth and potentially higher inflation in the future. Think of it this way. If people expect the economy to stay strong, they'll demand higher returns on their long-term investments. This rise in yields is essentially the bond market voting with its dollars, saying it believes in continued economic strength. But here's where it gets tricky for investors. If the economy keeps performing well and bond yields keep rising, it could put pressure on stock valuations, especially for high-growth companies. It's a reminder that sometimes what's good for the economy overall can create challenges in certain parts of the market. Now, here's where things get interesting. Despite all these positive economic indicators, the market is still pricing in multiple rate cuts for the coming year. In fact, many investors are expecting up to 6 quarter-point cuts by mid-2025. This would bring the federal funds rate down from its current level of around 5% to about 3.5%. But why? It seems that old habits die hard. Traditionally, the Fed has cut rates during economic slowdowns or recessions to stimulate growth. However, we're not seeing signs of a slowdown. Some market participants may be overly optimistic, hoping for a return to the era of easy money. Others might be anticipating a delayed impact of previous rate hikes. Whatever the reason, this disconnect between market expectations and economic reality is what's causing concern for Larry Fink and other financial experts. It's a reminder that sometimes the crowd isn't always right. Let's talk about what could happen if the market gets its way. Imagine the Fed caves to pressure and starts slashing rates while the economy is still running hot. It's like pouring gasoline on a fire. We could see a short-term stock market bonanza, with prices skyrocketing. Sounds great, right? Not so fast. This artificial boost could lead to dangerous levels of inflation and create a bubble in asset prices. And we all know what happens to bubbles eventually. They pop. On the flip side, if the Fed stays the course and keeps rates higher for longer, we might see a different kind of turbulence. The market, having priced in those rate cuts, could throw a tantrum. We're talking about a potential correction of 10% to 15%, maybe even more. It's a classic case of buy the rumor, sell the news. Except in this case, the news never comes. Either way, we're looking at some choppy waters ahead. The key for us as investors is to stay alert and be prepared for both scenarios. So, what's an investor to do in this uncertain climate? Let's break it down into 2 scenarios. First, if the Fed does cut rates aggressively, we could see a short-term boom in the stock market. It might be tempting to ride this wave, but remember, what goes up must come down. Be prepared for a potential sharp correction down the line. On the other hand, if the Fed holds steady and disappoints market expectations, we might see an earlier but potentially milder correction. This could actually create some great buying opportunities for long-term investors. Either way, the key is to stay diversified. Keep some cash on hand for opportunities, and don't try to time the market perfectly. Speaking of opportunities, have you been keeping an eye on PayPal lately? In my last video, I dove deep into why PayPal might be on the verge of a major breakthrough. With new leadership, impressive growth numbers, and some game-changing strategies in the works, it's a story that could have huge implications for tech investors. If you're intrigued by companies poised for potential explosive growth, you'll definitely want to check out that video. I break down PayPal's global dominance, their big data advantage, and why 2024 could be a pivotal year for the company. It's the perfect complement to today's discussion on market expectations versus reality. You can find that video linked in the description or in the end card. Don't miss out on this crucial update.